How's it going out there? It's July 14th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. So, the biggest story of the week, by far, even though it's earnings season, a lot going on, economic data coming out, all this stuff, but by far the biggest story of the week was Richard Branson flying into space. He was on a test flight from one of his spaceships owned through his company, Virgin Galactic. It's SPCE is a symbol. So it reached an altitude of 53 miles, and this was on Sunday when he took a trip, and he flew with 3 company employees, I think it was 6 people in total, before landing successfully back on Earth. So Branson became the first person to blast off in his own spaceship, beating Jeff Bezos, another billionaire, by a few days. I think he's launching next week. A little bit of egos between a few billionaires, which you see all the time. But it's really amazing stuff. I mean, going into space. It's all over every news station, everyone covering it. Doesn't matter what industry. Branson's doing interviews, said his goal is to turn the dream of space travel into a reality for my grandchildren, for your grandchildren, and for everyone. Which is what Virgin Galactic is all about, right? Space tourism. And really cool, amazing achievement, great story. Just feel good story. Now, I love a great story just like the next person. I mean, everybody does. We love to be entertained, right? So I hate throwing cold water on something that so many people are positive about. But I really need to share the story with you that nobody's telling. At least I'm not reading anyplace. And it may change your opinion on Branson. And again, this is at the height where everybody's most excited, just went to space. But it could change your opinion, especially with Virgin Galactic, since what Branson is doing to the retail investment community when it comes to Virgin Galactic. Holy shit. I can't think of anybody. Swindle, sham, deception, con, pick it. Whatever you want. But man, what a joke. I'm sitting by watching. The SEC's not doing anything. Regulatory bodies aren't doing it. Nobody's doing anything to stop this. I know what you say. What are you talking about? You just went to space. It's not getting an all-time high. Everything's great. Look, I like Richard Branson. He's an innovator, entrepreneur. He's a disruptor. I heard great stories about the man. I hear when people are around him, they just speak to him 10 minutes. Just listen to him. He's going to motivate the hell out of you. And I also know that after this successful test flight, you're not going to see a lot of negative stories written about him. He's popular, has a nice smile, he's a billionaire. Investment banks are definitely not going to say anything bad about him or the stock. I mean, these guys are foaming at the mouth since Virgin's likely going to have to raise billions and billions and billions of dollars over the next few years since they won't be generating any meaningful revenue. I didn't say earnings, right? You need revenue. You have a ton of revenue and you pay your bills and you pay your employees. They don't have revenue coming in. Meaningless revenue. So they're not generating sales or any meaningful sales anytime soon, which means they're going to have to raise a lot of money, which is why the investment banks love you, right? That's what they want. They know they're going to have to use them to raise money, so they're not going to say anything bad about it. Now, to start off here, let's take a quick walk back in time to October 2019. That's when Branson launched Virgin Galactic through a SPAC with Chamath Palihapitiya, whatever the last name is, Chamath, in 2020. In October 2019, right before 2020. And basically, they bypassed the traditional IPO. And they did it through a direct listing. And it raised $450 million, which put the valuation of the company at $2.3 billion. Pretty expensive for a company with no sales. But people love the story. Because once this thing came out, the 2 most high-profile billionaires in the world, Chamath and Branson, you could throw Elon in there, but not in this case. But one of the most high-profile. But Chamath and Branson, they turned up the marketing machine. So when Virgin debuted on the New York Stock Exchange, it's October 28th, Chamath, who became chairman, Branson, who's the CEO, took an amazing picture of themselves across the street from historical building. He took it from the historical building overlooking the New York Stock Exchange with their thumbs up, going, hey, this is great, this is awesome. And across the street was a New York Stock Exchange, and it had a massive banner of Virgin Galactic on it. And I know it's from the historical building because I worked right across the street from there for 5 years when I was at the street. And You could eat lunch on the steps. It's really pretty. You can never go in a building, but I guess when you're a billionaire, you get access to everything. So he took this nice picture with them overlooking and, massive display, the whole banner across like the New York Stock Exchange, massive, right? So like with thumbs up, this is great, space, awesome, right? Then they started doing interviews all over TV, which, a lot of this is also buried in their S1 filing. So during the interviews, Virgin Galactic said, again, keep in mind, this is still October 2019, it expects commercial space flights to begin by the summer of 2020. They just got the okay. Branson just came back now. Great, you can say, well, COVID might have a little bit of whatever. That's what they said, right? That's what they sold the deal on. We're not even there yet, right? Not even there. Maybe next year. We'll see. Said it already had reservations from 600 people in 60 countries, representing approximately 80 million in total collected deposits and over 120 million of potential revenue. Said all these people signed up. You probably had signed up for like $10, kind of like when you buy a Tesla car, you put 100 down and they count it as, look at all these buyers that are going to buy Tesla cars. Well, let's see if that pans out. That's no guarantee. The company also projected that by 2023, that's not too far away, it would generate $590 million in sales, an EBITDA of $274 million. The company was generating like $4 million in sales at the time, lost $173 million. This is at the time they're offering. Today, sales are lower than $4 million. I mean, Curzio Research, our CEO, we almost do more revenue than these guys for 2020, right? So sales are lower. Losses are much, much, much higher, and this is compared to 2019 when they made this claim. So then Chamath went all over CNBC, great marketer, saying that direct listings are the way to go. Benefits retail investors. I mean, look at this. Look at this deal we just did. And he actually said it benefits retail investors, direct listings. I mean, what a crock of shit. You could tailor things and kind of, talk out of both sides of the mouth. We see it from politicians where they won't. This is an absolute lie to the public. It's a lie, direct listings. Direct listings are not good for individual investors. They're not. They're great for insiders like himself where they do not require the 180-day lockup period. They get to sell these things in a much shorter period, sometimes that day. Robinhood. When Robinhood goes public, they're going to be selling. Insiders are going to be selling the day it comes out on the direct listing. So you could dump shares almost immediately. And also through this structure, this SPAC and his Chamath SPAC, you can issue warrants to the SPAC and they don't have to report them. I don't know if you guys are familiar with warrants or not, but holy cow, that adds massive, massive dilution. And, corporations say, yeah, this is new money coming into the company. That's great. No, it's not great. You're diluting the hell out of people. And they're going to come in at a much lower price, and they're immediately going to freaking sell it and dump the stock because they exercise the options in the money, which, the warrants in the money. But they don't have to report any of this. All these side deals that they did with other investors, they don't have to report any of this crap. Anyway, after all the hype BS, everyone wanted in. Why not? I mean, it's a great story. Billionaires, rocket ships, space. You bring in Chamath, who has massive ties to Silicon Valley, major influence to young investors all over Instagram, Twitter. I mean, you can see why so many retailers are like, holy shit, I need to own this thing. This thing's great. It's awesome. Now, through 2020, the stock held steady between 20 and 30. Then the first few months of 2021, this is where things get interesting. The stock took off. Went from $35 to $55 a share, an all-time high. Once that happened, what do you think the insiders did? They used the opportunity to dump the crap out of it, including Chamath and Branson. More on this later. So after that move high, the stock started crashing and went from 58 to 17. This is mid-May. So we're only talking 2 months ago, guys. Right now, we'll catch up in time. 2 months ago. Now, when the stock was at 17, 18, 19, 20, it was crashing. Everybody knew on the inside that Virgin needed to raise cash. Since they were planning on launching in July, they don't generate any revenue. Again, you have to generate revenue. You can have massive losses, but, the revenue's coming in. That's how you pay your expenses. That's how you pay your employees. You have no revenue coming through the door. So you have to continuously raise money. And the company was burning through cash like crazy. So they knew they need to raise cash. They didn't want to do it at $17, which is kind of around the friggin' IPO price now. So what did these guys do? Hey, let's turn up the marketing machine again. So in May, had a successful test flight, which started pushing shares higher, made a big public thing about it. Then last month, the FAA gave approval for a full commercial license to operate its spacecraft with passengers. Again, another positive development, which is pushing the stock higher. Then you have a massive short position, which these guys know, and the shorts started running for cover. Now it's pushing the stock higher, even higher. Then Branson announced the date of his flight. Hey, I'm going to go. It's going to be this date, which was on Sunday. And his stock revs high. Now it's in the high 40s. And then on Sunday, Branson launched into space. Huge success. Doing interviews everywhere, telling you that commercial space flights are coming. It's exciting. It's awesome. So what? I'm British. I own a British airline by launching my first trip into space from New Mexico. Doesn't matter. This is awesome. Who cares? It's still magical. Yes, she said that, magical. So Branson is super excited, and he should be. I mean, you guys just went to space. I get it. The world is super excited. Oh, space. We're going to go to space one day, right? We're going to definitely go to space. It's $250,000 to go there. So good luck for most people. Just maximum optimism. Maximum. And then what does Branson do? At the peak of the ultra excitement period, he announces a $500 million capital raise right in investors' face. Shoves it right down their throat. So as Branson is doing all these interviews everywhere on Monday, right? Later going crazy. This is amazing. The stock is absolutely crashing. It's down 17%. Granted, last month it ran up a ton in a month. It ran up a ton. But now it's crashing because all this optimism, the perfect timing. Let's raise money at the highest possible price. Okay, good for them. Now, I took a closer look at this deal. Again, a story nobody's telling. This is awesome. I think it's awesome. I don't know if you think it's awesome. And I'm getting to a very, very big point here, important for all of you listening to this and retail investors. So, of course, the two lead underwriters, I'll give you a guess. Okay? I'll give you two. You're only going to get two guesses because you're going to get it right. Goldman and Morgan Stanley, which they're getting paid $300,000, which seems reasonable, and at least 2% commissions. So that's a quick $10 million for these guys. Quickly. Boom. Right? I can almost guarantee these guys are making a whole lot more through warrants. More on this in a second. I'm going to break that down. It's important. So I took a quick look at the filing and found a few interesting things. Again, things I'm not hearing talked about much in the media. So the offering was from Friday's closing price, and that's in S1. They had 49 in the filing for the SEC. Sorry, $49.20. That's, close to its all-time high. Highest in like 4 or 5 months. I mean, it was 17 in May. It's $49.20, right? So that's the number that they used. And Virgin has 237.3 million shares outstanding, and they're offering 10.1 million. So they say, 10.1. So they say, which equals roughly $500 million they're looking to raise. So again, I'm not going to throw a lot of numbers at you and get you confused. I want you to follow along because it's important. So the total amount of shares after the 10.1 million share capital raise, they say, is 247.4 million shares outstanding. But when you dig a little further, in the fine print, it says the share count doesn't include, guys, listen to this, 8 million shares of common stock issuable upon the exercise of a warrant outstanding as of March 31st, 2021. Okay, so March 31st, 2021, warrants, 8 million of them, with an exercise price of $11.50 per share. As of March 31st, the stock was at 30. So the 8 million shares of common stock issuable by the exercise of warrants, it's giving free money to people. Right? You're giving warrants to people when they're already, right off the bat, 8 million. But the share cap doesn't include those 8 million. It also doesn't include the 5.4 million shares of common stock issuable by the exercise of options. So these are options outstanding, same date, March 31st. Again, the stock was at 30 back then. Right in the money. You're handing free money to people. I wonder why. Is that allowed? I don't know. I know Apple got into a lot of trouble early on. I forget what it was, probably 15 years ago. But Apple can't bring over the 3 leading executives from Google and give them stock at $25 a share. You're not allowed to do that because otherwise they'd have every single employee who's amazing, who's great in the entire industry working there if you're able to do that, right? And all these guys, you can't do that. These guys are clearly doing it. And it's right in these reports. Gets better. 4.1 million shares of restricted stock units. Again, this is outstanding as of March 31st, 2021. And then they have 7.7 million shares of common stock reserved for future issuance. For future issuance under our 2019 incentive award plan. And this was as of March 31st, 2020. I don't get it. I mean, was the incentive program of 2019 never met? Because it should have been based on stock price, and your stock price went a lot higher from the IPO. So why are you giving more shares away for an incentive award plan from 2019. I mean, you're re-anting this? You're giving free? Is this a cover up to give more shares to whoever, which we don't know? Right? Common stock 7.7. So no lockup. No lockup on these either. There's no lockup. So imagine that. I'm able to get 8 million shares, 8 million warrants. Whatever I did for the company to get the 8 million warrants. I don't know who got them, but 8 million warrants. And say my stock's trading at 10 and you get to exercise it at $2. And right off the bat, what are you going to do? You're going to exercise them right away. You make money, but what you're doing is diluting the shit out of existing shareholders. Anyway, when you add all those shares I just mentioned, most of them are going to be sold almost immediately because they're in the money. That's another 25 million additional shares. That's another 10% plus dilution. You might be saying 25 million shares. What's the big deal? Well, put it another way, the 25 million shares is worth $1 billion at today's stock price. $1 billion you're giving away to who knows who for free. Welcome to the world of SPACs. I'm just getting started here. So Virgin has a lot of warrants outstanding. Do you know how many? I have absolutely no clue because they don't have to disclose it. They don't disclose warrants. They could have issued 100 million warrants with an exercise price of 30 cents. But nobody has a clue because you don't have to disclose it. And that's why the company's being sued by several law firms. Because the SEC, and this was just a couple months ago in April, said some SPACs may not have properly accounted for warrants sold to investors. So in the past, many SPACs classified warrants as equity on the balance sheets. However, the SEC is now saying, quoting, that in certain circumstances, the units would have to be classified as liabilities rather than equity. So what does that mean? They're now going to have to disclose these warrants. And it's why the company pushed back their filing because they had to account for a lot of this stuff, but they still haven't reported. Nobody knows how many warrants they have. But if you notice, you're seeing the dive in SPACs because when people get a look at those warrants and the deals that they're giving certain people to raise money and through those pipe deals, holy shit, you're going to see why every single billionaire, every single large investor is doing everything they can to launch a SPAC. Because one, you're putting money into it. Two, you're able to sell it pretty much on day one. You're able to give warrants to whoever you want to raise the money. What do you care? You're in at a penny, right? You give warrants to $1, $3, $7. You're coming out at 10. You buy a company. It comes out at 12, 13. You have the retail investors buying it. What do you care? Now you're going to have to disclose all this shit, all the money. And best yet for these guys is they're going to make massive, massive gains, which I'll show you in a minute, taking on no risk, and they're gone. They're out of the stock. They're gone. I mean, who doesn't want to make a $25, $50, $100 million in a couple of months with no risk? That's a pretty cool deal, I think. That's not a bad deal. I'd like to do that. Now, getting back to the offering. So this deal was announced when shares were trading over $49. Shares sold off on Monday pretty hard to $4 a share. It fell 17%. It was great because it was like 5%, 7%, 10%, and kept going lower and lower. The more interviews Branson said, and everyone was patting him on the back. This is great, and he's elated, loves it. The stock was crashing for investors. And if you look at the offering, or into this offering, insiders have been dumping shares like crazy over the past couple months. Again, even into this offering, which is why you're dumping it. You're selling it to a whole bunch of new investors at $49. Why are you dumping it? And if you look at Chamath, he dumped his personal stake for over $210 million near the peak in January, February. I think what I read, he invested around $100 million, October 2019. Again, this was his SPAC when he decided to team up with Branson. So, 210, saying he made $100 million. So a cool $100 million in less than a year? That's a pretty good deal. Good job. Good for him. Also includes Branson. Branson sold $660 million worth of stock up to last month. You know what he did just a few weeks ago? Sold another $150 million worth of stock at $25. At $25. It's $49. Now it's $40 after the offering because it crashed. But if you got Branson selling $150 million worth of $25, doesn't that tell you where he thinks the stock should be trading? I mean, if he really thought it was going this high, do you really think he'd sell at 25? And looking at insider sales, which, again, I like looking under the hood, the story nobody telling, just the past quarter. So you're looking at all the top holders. So first, Virgin Group Holdings, largest holder, sold 9% of their holdings. This is last quarter. You have Abar Space, I don't know, I guess Space Fund or whatever, who owns that, I'm not too sure, but they sold 20% of their holdings. You have Susquehanna International Group sold 38% of their holdings. These guys own a massive amount of shares. So Virgin owns 23% of the company. Aerospace owns 5% of the company. These are massive stakes. These guys own a little bit less than 1% who I'm going through. So Susquehanna, you have BNY Mellon selling some of their stake. Neuberger Berman, pretty big fund, selling 56% of their holdings last quarter. So everyone's selling. And these guys have an offering going all the way up, goes all the way to $49, and now look what they're doing, right? And now they're launching an offering to new investors. And the best on this is Morgan Stanley. So Morgan Stanley dumped 28% of their positions. Morgan Stanley Investment Banking and Brokerage Investments. Remember I said Morgan Stanley is one of the agents on this deal, Goldman Sachs. So these guys were selling shares to new investors to get into this deal. That's what the agent does, right? He's got the investors and then the middlemen. They collect a fee on the deal. Yet they sold 825,000 shares themselves last quarter when the stock was in the low 30s, right? 28% of their entire position. I mean, you can't make this shit up. Morgan Stanley Institutional is selling shares, but yet they're telling their clients or other clients to actually buy it. F1 being the agent. I mean, it doesn't get better than that. I mean, that's freaking awesome. Now, why would they do that? Is because there's some kind of warrant deal going on. Again, they don't have to disclose any of this shit. Nobody knows. So let's bring this home real quick and bring it all together. Because when you look at the fundamentals of Virgin Galactic, which I do occasionally, since I'm a research analyst, Virgin is sitting on more than $600 million in debt. Expected to lose over $300 million in 2021. Now, I'm not sure how many seats Branson is planning to have on each spaceship, but it better be a lot. I think right now it's 6. And then, you get 2 pilots. But the $120 million in pre-sales, not really going to make a dent, even if all those people do pay up. And I'm not sure if they're going to pay up more than once. You go to space, oh, that's cool. Okay, let's do it again. No, you did it. I mean, it's basically to say, hey, I did it. Look, everybody, right? That's what all the rich people love. They love the attention. They love it, right? That's why Branson going up first and doing all these interviews, and Elon Musk. You can see Jeff Bezos next week. I mean, it's all about they have enough money. It's publicity. I know these guys want to change the world, but a lot of this is for Branson's personal. I mean, personally, it's great for him. But when you look at the fundamentals on this, I mean, you have one ship, right? One ship. It costs $400 million to build a new one. Yes, I looked at the math, done the homework on this. And the next one's not coming out till 2025. So where are you going to generate money from? You going to send this ship up like 3 times a day starting next year? I don't think so. But where are you going to generate the money from? I guess more capital raises are coming. Usually when you look at space, the only way to get funding was from the government, NASA. It was the easiest way to waste tax dollars. And I won't say waste. I mean, listen, you want to explore, but you have to put billions into it and make numerous mistakes. So it's money, a lot of money gets spent. And where do you have this money? Governments, because they don't care how much they spend. They're not looking. And now you have corporate a little bit, and you're saying, okay, well, Jeff Bezos is, these guys are worth hundreds of billions. Not even the billionaires. They're worth like hundreds of billions. Some of these guys. So they build their own spaceships and stuff like that, but they still need the capital. They need the capital. And you know what? They're not going to get it from the government. So they have their private companies. They're not really going to get into the traditional IPO market. So what do? They launch in these SPACs, which is great. And you know where they get the money from? From you. From you. Listening to this. Retail investors. Let's sell them a story. We'll dump the crap out of this right in their face. Maybe the stock goes up a while, giving them some nice gains, which we've been seeing. And when the wheel stops spinning, nobody's going to know shit. But this funding, this recent of $500 million, I mean, it's classic Wall Street. You look at Branson, did a great job selling this story. Chapman did a great job saying, just space is the future. The guy's out of the freaking stock in a year. Telling you how great everything. He's out of the stock in a year. Doesn't give a shit. He's not looking at long term. He's not looking at you like space, new frontier, huge upside. I mean, eventually numbers matter. You have to make money. How is this company going to make money? They're barely generating revenue. A couple $1 million in revenue now. I mean, all those forecasts, 500 and what was it, 90 million, whatever it was, in revenue you expected 2023? Are you out of your mind? Where are you going to get that money from? You still one ship, 6 pairs. How are you going to get that money? It's impossible. Where'd you get those numbers from? Well, we needed to sell this deal And we need to put great projections on it. And that's what we did. And good for them, because all of them got rich. Branson, great job selling the story, making a fortune on this, even if the stock goes to zero. He already made a ton of money on this. His early backers made an absolute fortune. They got it at very, very low prices. Most, again, who are no longer in the stock, even though they told you space travel is a future. I just mentioned with Chamath. And then Branson got to be the first to go to space in a private spaceship. His name's going to be written, I guess it won't be written in encyclopedias. They don't exist anymore, but people are going to be talking that for decades and even long after he's gone. But let's talk about the average investor. What'd you get? You're buying a company that's likely never going to be profitable. Never, ever going to be profitable. I mean, I'm trying to do the math. I don't understand it. I don't know how you're going to be profitable. I mean, maybe, 20 years from now, 10 years from now, when you have 4 ships, 5 ships, maybe you bring in more competition in the market, got to lower the price. I don't know. I can't do the math. I can't figure it out how they're going to make money. So Virgin's going to have to continue to raise cash like crazy since it won't generate any meaningful revenue. Again, revenue, guys. We're not talking revenue or sales for many, many years. But how did this all work? I mean, looking back in the day, I mentioned the only stupid money chasing space was NASA taxpayer dollars through NASA. But today, the only way this works is to get a lot of stupid people, retail investors, to buy the stock up here after the offering. And then what do you have? You have Morgan Stanley, Goldman Sachs generating at least $20 million on fees just off this one deal because they got warrants on top of the $10 million in stock, right? And $300,000 in fees. They got warrants. They don't have to disclose them. What are you kidding me? Of course they did. Of course they did. If you're getting those two guys on board with just a 2% commission, yes. That average commission is usually like 5-6%. 2%, yes. You got warrants, and the fact they're exercisable on the spot, hey, that's free money. You just saw Goldman report beating estimates by how much? 50%? $5? You just saw them report this week, right? Where do you think that comes from? Look at the investment banking fees. Look across the board. The deal, especially SPACs, it's good for all these insiders involved. And almost every major insider, Virgin Galactic, what are they doing? They're dumping their shares right down your throat right now. Right down your throat. And look, I'm not telling you to short the stock here because it can go to 100 before it crashes. I have no idea. I mean, we've seen that with AMC, which makes absolutely no sense. I mean, the stock peaked when it was doing, max box office receipts at what was it, 12 million in 2018. Now they're doing, it just passed $1 billion, and the stock's market cap is 20x what it was back then when you had record box office. It doesn't matter. You don't know where stock's going to go, where they're going to buy them, the short squeezes, nothing. It's very dangerous to short a stock in this market because who knows? I mean, you see the shorts, you see the short position, and the right story creates that short squeeze, and that thing's going to the roof. So I'm not telling you to short the stock. I mean, go to 100 before it crashes, even though Branson thinks it's not worth $25 because that's what he was selling it. But if he really loved this deal, this $500 million, and the best people do this when they raise money, they participate in the latest offering. So you have the insiders, and they participate in that latest offering. Or they write a check. Branson didn't write a check. He's selling shares. He's like, I ain't freaking buying this stock at 40, 45, 49. No way. No way. I own a ton of it. I'm selling. I'm dumping it. I already made my money on it. Now, where am I going with this? What am I trying to tell you here? You have to understand, as the retail investor, Wall Street is relentless. They're relentless. They can do everything in their power to fuck the retail investor. I'm sorry to curse, but it's true. And it's not personal. That's their job. That's their job. Using people to get filthy rich. Just like they did during the credit crisis. Look at the banks where they are now. Holy cow. Supposed to put laws in place so this doesn't happen again. Now, what did you do? You made the banks 5x times the size they were when you bailed them out? During COVID. Paying off politicians by lobbying. I mean, come on. We see this, right? But Wall Street is relentless. But the most important point here is none of this crap works without you, without the retail investor. With that last bit to sell everything to dump it to you. And today, you as a retail investor has enormous, enormous power. More power than any other time in history due to networking, social media. You can trade for free now. Zero commissions. And what is that doing? It's bringing in tens of millions of new investors. Look at Wall Street Bets, the Reddit crowd, 10 million strong now. Basically, bankrupted Melvin Capital. There's an $11 billion hedge fund that was short GameStop and wrecked them. And they're still around. They needed billions in cash infusions. Robinhood, over 30 million people strong. 11 trillion in IRAs, where so many of you investing on your own and using people like me or financial newsletters to find new ideas. But the power that you have right now, it's being used by Wall Street, saying, wow, look how many people are going to be buying this stuff. They don't know. They're not going to read the stuff that I just told you. A lot of that shit's boring. I might have put a couple of you to sleep. Everybody says, oh, Wall Street's going to fuck you. They always do. I just wanted to go over and show you exactly how they do it. Because when Branson's out there doing interviews, watching the stock crash, they're raising money. They're not going to generate profits ever. Never, ever. I don't know where he thinks the stock is going. I hope, we see more exploration in space in it, but it's at the expense of you, the retail investors. That's why they're doing SPACs. They couldn't do it to a traditional IPO. Do direct listings so the insiders could dump on day one. There's no lockup period. Now they're liquiding again to the next SPAC and the next deal and the next deal. That's why you're seeing the same guys launch more and more SPACs. It's not like suddenly they came into another $100 million, $50 million. No, they just made $20 million, $30 million off this deal in a couple months. I made $100 million off of this deal like Chamath did in a year. Let's start another one. Let's keep going and going and going until the wheel stops. But Wall Street right now, they're using you. And sure, some of you are making money on ESG stocks, SPACs, but Wall Street, they're capturing 95% of these gains with almost zero risk. Wouldn't it be nice if that was you? Because they know they could sell the shit they bought for $1 with warrants they don't have to disclose and sell it to people like you at 10, 11, 12 when the SPAC finally takes over, the holding company takes over somebody. Hey, these guys got to be buying it. Okay, great. We'll just sell it to them. And for now, it's all working because those SPACs will go from 10 to 15 or in some cases 30 to 40 like in Virgin Galactic. But guys, when the wheel stops spinning, and it has for most SPACs, investors are losing a lot of money in these things. Like stuff for ESG stocks, you're looking at most of these things are down 30% plus from their highs. Wall Street, they get away scot-free, already out of these positions. They bought in the pennies, while you, the retail investor, gets left holding the bag. Now, the question is, how do you change the game? How do you become the person getting in early? How do you become that, right? That's the goal. Because that's what great investors do. It took me a long time to realize that through my career, but the deals that I get into, which open to Curzio One investors, are deals that not everybody has access to. You have to be the in crowd. Socialize with the right people. It's the way it is. But how do you recognize that power? And you do through disruption, through things like security tokens. We don't need big banks to raise money and go public. Reg A offerings, they raise that considerably, $75 million, where any investor, anyone who listens to this right now, can buy into a private company. And both of those options are going to allow retail investors to buy into companies during their super early phases of growth. Not when they IPO at $5 billion plus valuations with a forward PE of 200 and the stock's up 20% on day one. It opens up 25% on day one. And you have the insiders dumping those shares as you're buying them because they're doing a direct listing and they could sell on day one. You disrupt by networking. I say it all the time in this podcast, the power of network, all the emails I get from people over 100 countries this is broadcasted to. Get emails from, of course, all industries, CEOs, hedge fund managers, small business owners, students, economists, doctors. And that's incredibly, incredibly powerful to see that information in real time. That's why I encourage you, FrankCurzioResearch.com, to email me. Networking through Wall Street Bets, now 10 million plus. Robinhood, 30 million plus accounts. Even crypto with Coinbase, where institutions and Wall Street still have a little understanding of the power of Bitcoin. And it's so funny because what do we say? Oh, it's a store of value. It's not a store of value. It's alternative to gold. It's not alternative to gold. It's alternative currency. It's not a currency. Back and forth with the bears. Nobody gets it. No, it's none of that shit. It's not what Bitcoin is about to the original adopters. It's communicating. Class war. Telling Wall Street, politicians, governments, we're sick of your bullshit. And it's about a revolution. And it's taking place right now. I know why I'm so excited about security tokens. It took a while to develop, but it's here. To the point where I've been doing this my entire career, my life, and I base my entire company on this concept of disrupting Wall Street by creating the Curzio Equity Owners Token, which, by the way, if you haven't had a chance to watch my presentation, it's absolutely for free. It's our annual meeting for 2020, breakdown of financials, growth initiatives. But more importantly, I share my vision, the future of security tokens, how it's inevitably going to disrupt Wall Street, and how this is by far the biggest industry biggest total addressable market I've ever seen in my career. Nothing's even close when it comes to tokenization. How many assets can be tokenized? So you can go see it at www.curzioequityowners.com. Again, it's absolutely for free, no sales pitch, just a vision from someone that's been in this industry virtually their entire life, explaining how tokenization is here. It's going to disrupt the entire global investment banking industry, and how Curzio Research is in perfect position to be one of the biggest players in this massive multi-trillion-dollar industry. A lot to digest there, guys, but I wanted just to break down. That's a story nobody's telling, okay? Because the retail investor always gets fucked. Something that I've seen throughout my career, and those days are going to come to an end. They're coming to an end. And the way you do that is by disrupting Wall Street, and there's a lot of things that are disrupting Wall Street, especially those security tokens, the Reg A offerings and stuff like that. Very exciting stuff. You're going to hear a lot about that in the future, how you guys could get into some private deals, how you guys can invest in companies at the very early stages. Again, it is risky, but at least you're getting in when a lot of these insiders are used to getting in. And that's going to level the playing field, and that's what we do here at Curzio Research. We try to level the playing field for all investors. Now, let's get to my wonderful guest. So one and only Andrew Horowitz. I've been on him for a few months. He's the founder and CEO of Horowitz Company. Also host of the incredible podcast, Disciplined Investor. Going to have a great conversation. I'm going to break down earnings season, which is here. I've seen the banks reports very, very strong earnings. You can see over the next 2-3 weeks, lots of earnings come out just about for every S&P 500 company. We'll talk about new lockdowns internationally, which companies will be impacted. And of course, like Andrew always does, he's going to share a lot of new ideas with you, including one name that's been getting absolutely smoked. I can't believe he likes this name. I was just thinking about this name. But it's definitely going to surprise you. And by the way, Andrew, when it comes to our Dollar Stock Club portfolio, has an incredible track record where we take one pick, and whatever pick that is, you don't really know, but it's subscribed to Dollar Stock Club. I think it's $4 a month or whatever. It's a very, very low price newsletter. But we are able to track the investments of almost everyone that we interview, and analysts and stuff like that. So we put a pick in there every week. Andrew's been one of the best performers with his picks. So definitely listen up. It's a great interview. And you know what? Let's get to that right now. Andrew Horowitz, thanks so much for coming back on Wall Street Unplugged. What's going on?
Hey, Frank. How you doing? It's summertime, and look at that. Look at what's with the hair.
I don't know. You know, they cut a little short to have someone new. It's really short. I mean, I really don't care. Like, it always grows back, so I know people get upset. But
it's looking really short, like right? I'm gonna make a wild guess here for a second. It looks like you're either going to be entering a strongman competition or a bodybuilder competition. Just sort of getting that look.
No, I just been working out and trying to stick with it. But you know, I mean, you know me when I was really, really fat. Back in the day, so
large.
You know, I had to lose weight. We have hefty kids and everything. I think we were both there, right? We were both like heavier. You lost a lot of weight. You look great.
I was a good 30 pounds heavier than I am now, and you know, then I was down. I'm also 30 pounds heavier than at my lightest, so kind of goes back and forth, but still keep it off a little bit. It's tough. It's tough. The older you get, Frank, you'll know. The older you get, it's like, you know, I didn't eat for 3 days. How come I gained a pound? I don't understand. You know, it's crazy.
Yeah. I went to a barbecue and I'm eating like a burger, and then I had another one without the bread, then the fruit, and they got cupcakes out and everything. I'm like, man, it's hard. It's not easy. It's hard. And I'm miserable, man. I love eating. You love eating. Look at all the pictures you post all the time. This guy, guys, you got to see, you know, your posters on your Twitter feed and stuff like that. But the food that you cook and grilling, and it's just amazing, man. Really serious. I hate when you send me that stuff, to be honest with you. I kind of wish I was there.
It's tough. It's tough. I mean, listen, it's tough. There's barbecues, there's birthdays. It's not like, you know, a kid's birthday is one thing. Like last night I went out to a birthday party. They went out to Capitol Grill we went out to, and there was just a table full of food. I'm like, I don't want any. I'll try it. Yeah. I'll take a little bit of that. And then they had at the Capitol Grill, they have this thing called the Generous Pour, which is like 7 different wines that they pour for you. And it's like, I don't want any of those. I'm like, okay, can I take a refill on that one and a refill on that one? I like the, you know. So as you get older, the birds just get a little bit more fattening, I think.
I hear you, man. So look, I love having you on, especially, you know, right before earnings season. You're always giving out ideas and stuff. But, usually we send notes to each other back and forth before the interview, or maybe topics that we could touch on or whatever. And one of the things that you said was interesting, because I'm getting the same thing here. You have earnings coming out, you have stocks all-time highs, household wealth all-time highs, and you said something interesting where clients are worried, about a market crash. I'm hearing the same thing, and if it's even possible, because we have our government and the Fed, which is like the same thing now today, basically going to do everything in their power to avoid a recession, right? So how do you answer that? Do you say, well, for me, I'm always like, look, you got to be cautious, hedge a little bit of your portfolio, hedge. Hedging was the worst thing you could ever do, and in the past 7, 8, it keeps going higher and higher. But it seems like eventually it's got to stop, right?
So it's interesting because I kind of made this analogy because this week on the Disciplined Investor podcast, my podcast, and I talked about this idea of jumper cables because people are like, hey, you know what? What's going to derail the markets? I'm really worried that I have some cash. I don't want to put it in right now because the market's going to crash. I'm like, listen, let's slow down. Their biggest worry is what happens if the Fed starts to pull back. And I said, and their biggest worry also is if the Fed doesn't pull back. It's kind of like, okay, no matter what, they're worried, right? And I tried to make this discussion and this this viewpoint of, when a car battery dies, what do? Well, you call a buddy like, hey, you got jumper cables, come on over, and you kind of hook it up, you let it charge for a minute, and you charge it up, then you turn your car over, you take the cables off, you're ready to go. Then the internal components of the engine, the alternator and everything about, depending on what kind of car you have, if it's a non-electric car, we'll keep it going, right? And charge those batteries and get it going. Well, the same thing with the economy. Right now, we have the jumper cables very firmly engaged with regard to the Fed, to the economy, probably longer than they need to be. One day, they're going to pull those jumper cables off, and the economy theoretically should be running on its own through its own growth process, et cetera. Now, the problem is they're here for too long. We saw the inflation numbers come out today, a whopping 0.9% month over month, the largest since like 2008. We saw a 5.4% year over year, which is substantially higher. It was 0.4% higher than the expectation. So what's really interesting about that is it doesn't seem like a lot, but if we went 0.2 in the past, it would be a big deal. Markets aren't reacting because the Fed has had their hand on the pulse and probably bonds not moving up, which was very interesting. They did drop down significantly after the news, but right when the market opened, the bonds started dropping down, a lot of excess money going in there. Answering your question is this, is there going to be a crash? What can happen? The only thing that I'm looking at right now is the potential for the Fed, which they're not going to do, is to pull out premature, or not even prematurely. It's at a point where they go quickly. They're not doing it. The second thing is earnings. Expectations are really high. And I know you, Frank, you read FactSet's information, right? And you saw the numbers.
Great, guys. Guys, FactSet, just go to Google, FactSet earnings, PDF, and it's for free, and it's amazing. They give you like a nice 25, 30-page report of everything that's going on,
Right. Yep. Update all the time.
I mean, you're looking at
one
earnings.
Of the things that we... Yeah, one of the things that's it's interesting in this most recent earnings season, there's one thing that's different about this upcoming earnings season than has been pretty much in any earnings season going back years and years and years. There's a few times it's happened before, but basically there has been a view, and they wrote about this. And I'm going to I kind of made some notes here. I said, on average, the quarterly bottoms-up EPS estimates usually decrease during a quarter. During the past 5 years or 20 quarters, the bottoms-up EPS estimates before earnings season has recorded an average decline of 3.8% during the quarter, which means that analysts are starting to sandbag a little bit, pull back a little bit, waiting for companies. Companies then jump over the hurdle, they beat it, and it's great, right? That's what we see all the time. A penny here, a penny there. During the past 10 years or 40 quarters, the bottoms up has recorded a average decline of 4% during the quarter. And during the past 15 years or 60 quarters, the bottoms up EPS estimate has recorded an average decline of 5% during the quarter. What's different in this quarter? In this quarter, analysts increased their earnings estimates for companies. They increased it by 7.3%, only second to the time they did before, which was when? The first quarter of this year, when they increased that by 6.5%. So what we're seeing right now is a very interesting situation. It's kind of like the economic surprise index. You've seen that, where analysts swing both ways and they're always on the wrong side of the pendulum. And what happens is they always have to, change and update. I am just concerned that we've gotten too far ahead with estimates and valuations temporarily, and especially as we're seeing it with the FactSet research information. Something to think about.
Now let's bring everyone in here. Yeah, let's bring everyone in here. So what Andrew's talking about is the institution. So most investors who don't cover it, like Andrew and myself, this is our job to cover this, is when you put on CNBC to see if your company beat earnings estimates, they're going to say they beat them or they missed estimates. That estimate is a consensus estimate of all the analysts, the institutional analysts, sell-side analysts that cover it, that provide estimates. So they come out with that median number, and then, if you beat it, you beat it. So it's whatever the analysts think. And usually the analysts, which you don't hear, right? You only hear about upgrades and downgrades in between the earnings reports, is they lower estimates a little bit. This way they come in, a lot of these companies beat even those lower estimates. And now you're seeing them raise estimates, which is interesting. It is a game. And it's important to understand, because a company could say, wow, we blew out the earnings by 40%. But you know what? Analysts may have lowered those earnings by 25% going into the quarter, right? So it's still the same number. I mean, but you just, the expectations were a lot lower, right? Because that's what you see. But, more to the point here is you're worried. What I want to see this earnings season is the guidance. I want to see how they feel providing guidance, because now you have the Tokyo thing with the Olympics. You have the international thing, right? Where it's a joke. I mean, there's 1,500 new cases in Tokyo. Just to put that in perspective, UK is opening up everywhere. There's 24,000 new cases, right, per day, and they're opening up everywhere. But Tokyo's like, we're not letting any spectators there because we believe there could possibly be an outbreak.
There's 43. There's 43 in Israel, and they're going to new quarantine procedures of anybody coming in and soft lockdown procedures right now. So we're seeing that there is in look at Australia. They went to a straight up, full out 2-week or whatever it was lockdown. I think they had a massive surge of like 12 cases. And I understand that they don't want the local spread. They're really concerned. Listen, if we have to admit one thing, that if you are in a situation in your own personal household, let's just kind of put it in that block right there, right? That, there's everywhere outside, you're starting to see some stuff going on. You don't want it in your own. You shut the door, maybe it won't, spread or whatever. All I'm saying is that they're getting a little bit crazy with some of this. There's no question about that. And certain countries around the world Israel's the interesting one because they have one of the highest vaccination rates, right? Question is it going to hurt the economy? I don't know. Mm-hmm. Yeah.
Well, that's the
thing. 92%.
You're looking at, what is it? It's around 35%, I think, the profits come, from overseas. But this is kind of a surprise, right? Because we thought everyone was kind of opening up, and we didn't think it was going to take a setback internationally. We're fine. U.S. is opening up. It's different. But that's what you want to look at earnings season, because how do you forecast for that? For those guys and I have to tell you, food companies, exporters, it's going to be hard to forecast. What about the autos? I mean, you think it's bad now. Wait to next 2 quarters. Holy cow. I mean, people don't understand how bad the auto industry is. There's 10% of cars on the lots right now. They can't get anything. Their plants are still idle. They said they were going to open them back up the last 2 months. They still haven't opened some of these up. You're going to see massive decline. So what companies have exposure to that, and what kind of guidance are they going to provide? I mean, there's a reason why you see Ford and GM talking about their EV portfolio, which isn't coming out for another 8 years, is because we really can't tell you anything about what's going on right now, because it's going to be pretty terrible production decline. So keep this in mind during earnings season as an investor. Companies usually, maybe not today where everything is bullish. Usually when companies don't provide guidance and they're supposed to, the stock gets hit. It means there's uncertainty, and the only way you don't provide guidance if you think it's going to go a lot lower. So I'm interested to see the guidance. These earnings are going to be fantastic. You're going to see blowout numbers, but going forward, I think, want to see the guidance. And do
you think, though, think they're going to see a return? Do you think we're going to see a return to, once again, getting guidance from companies? Because under the umbrella of, we're in a COVID environment, a lot of the companies said, you know what, we're not going to supply guidance anymore, right? And it was like, okay, all right, that's fine. Okay, no problem. And then they start hearing, well, you know what? Quarterly guidance and quarterly earnings, maybe it's not the best thing to do. We should be looking a lot longer term on the company, right? So investors look beyond. Look at the cruise lines, look at the airlines. Things weren't picking up. Things are still shut down. Things are pretty much still shut down for the cruise industry to a big degree. And meanwhile, the stocks made massive runs from their lows, right? Mm-hmm. So do you think they're going to actually come out with guidance? And is that going to be important let me just ask one other question and tag this with it. In an environment that information doesn't matter, it's all about just pouring money into a stock. or into an index to move it higher.
You're right. I mean, it's about the liquidity coming into the market. I would say it's not a black and white issue. I think for airlines, it might be a little difficult because you thought international travel was opening up, and that's not, and that's a big part of their business. The Delta is the major airlines, United Airlines, UAL and United. But, for the cruises, again, those ran up. People don't realize this, but so you're looking at the airlines. The airlines ran up, right? So they were like trading all-time highs, great, before COVID, pre-COVID. They've come down, and then they've gone back up. They were still trading around 20% off their highs, and now they took another leg down. They never got back to the highs. Cruises, on the other hand, they were like their enterprise values were higher than when they had every ship in the water and full ships, and they barely have any in the water. So I'm like, man, those expectations are kind of high. But,
the debt load. The debt load is ridiculous. The amount of debt the airlines took in, and then to see that United is making an all-time the biggest purchase of planes, and it's like a year ago, you're wondering if these companies would still be in existence in like 3 months. And that's the thing that's so fascinating about the airlines and the cruise lines. Think about how lean they run and the cost factors associated that these companies, after like a couple of months of not doing, they were like shutting down. There was like no backup plan, right?
Yeah. I mean, it that never happened in the history, right? Well, usually you could see they don't really forecast for a 20% decline. Maybe if they forecast for 20, 15% decline, what's going to happen? They don't, no major company forecasts for a 90% plus decline where you turn it off. So, they did get some help from the government, which is fine. But now when you look at everything open up and the prices, the pricing power, everybody has money. They want to travel. They need to get out. I mean, this is a massive boom to these guys, right? So it's going to be interesting how they do report. But just for other companies itself, look, you shouldn't be impacted by COVID anymore. If you're a Eurospace company, there's no way you should not be able to forecast. Everything's open. I don't care if you're a restaurant. I don't care if you're bars. I don't care what you are. Everything is open now, and it's just a matter of opening. So now you're going to hear more about the labor shortages. McDonald's just came out and said we're paying employees and going to tuition and stuff like that and giving incentives. I mean, you've seen that across the board. That's going to be a big story. But, going forward, Andrew, which you mentioned earlier a little bit about the government, like they're always – the one thing that scares the hell out of me, and people aren't nervous because you've seen a 10-year come down, right? It is inflation. So we do have inflation everywhere, but the 10 years coming down. It's confusing people. The bond market's not showing you, so people aren't concerned. Inflation is the absolute worst thing because the only way the Fed can't control that. The only way they can control it is they got to remove money out of the system. They got to almost force a recession. They got to raise interest rates. And that's an environment where if something, they could bail out and listen, they just spent $10.5 trillion to bail out the world. They'll do another 10, 20 trillion. It just comes out of thin air. Just turn the printing press on. This is something they can't control. So if you better hope it's transitory. I don't know if it's transitory. I hope for everyone out there it's transitory.
How could it be transitory? How could it be transitory if you're telling me that the cars are not going to be on the lots? It's simple that it's going to be transitory?
It's simple. Don't everyone that's raising prices for their business is suddenly going to lower prices. You didn't know that? I'm agreeing with you. I'm being sarcastic, but it's not. I mean, think about it. If you're a business, you're raising prices for food, for everything. You're not going to say, "Oh, okay, hey, we're doing better now. Let's lower prices." They still having labor shortages. They still open up at 80% capacity because they don't have enough people to work for them. So, yeah, I'm agreeing with you.
I mean, listen, once you use whatever phrase you want, once you let the genie out of the bottle, once the toothpaste is out of the tube, it's hard to get it back. But the truth is that, you know what? We're seeing this across the board in so many different things. It's not only this is where the farce of all this comes in. It's not only about prices going up due to demand, right? There's some supply issues out there. I am a boater, as you know, trying to get new engines. It's impossible. Put an order in April, can't even get a response as to what's going on. Meanwhile, I sell my engines, one day they're gone. Now, fortunately, I'm not an idiot. I didn't take my engines off before I got my new engines, right? So we put that in the contract, between myself and the buyer. And actually, I told him, you know what? I don't know when my engines are coming in. I have no idea. I heard it's going to be maybe a year till I can get engines. So the problem you're having is that with chips and cars and resins and all sorts of other products, hinges, issues with stainless steel. And it's a combination of the restart is also a problem that was predicated on the just-in-time manufacturing process that is not good in a shutdown startup economy. It's fine if things are rolling along just fine, but you can't do that without any inventory backlog. And I don't understand if you have that, the supply chain issues that are going to go on for some time, on top of the fact of all this free money, on top of the fact of what we're seeing in food prices, et cetera, how this is going to be a transitory inflation discussion, unless they say 1 year from now, look, we're still not rising as much as we were, right? That doesn't mean prices are lower. That just means that we're not seeing the consistency of massive price increases. So we stay at 5.5%, which is much higher. Attention Fed, 5.5% is much higher than your 2% average. And you get to that point, and even if it's at 4% for a while, it seems to me that companies are going to have problems because margins are going to be squeezed. Don't you agree with that, right? And then they're going to have to either pass it on, which is going to cause problems for the consumers. It's just something that, and then the Fed, what they're doing is they're buying $120 billion of bonds. Who knows if when these inflation numbers come out, they don't go to the market and start buying all sorts of treasuries to kind of make it look like nobody's concerned. You know what I mean? I mean, this game is ridiculous.
No, I know what you mean. I definitely know what you mean. And it is crazy too, because you talk about margins, and I will tell you that, for the margins, I think this is Credit Suisse that came out with this, but it was, I'm trying to find the exact number here this way, because I wrote about it. But so companies already posted Q2 numbers, very, very few, very small sample size right now. Everybody's reporting in a couple of weeks. Right. They have an average revenue beat of 4.5%, right? Again, small sample size. But historically, a 1% revenue beat is accompanied by a 4% rise in margins. So it's going to be interesting to see how that's why forecasting is going to be tough. Because if you're growing sales and you're beating sales, you almost have to forecast that margins are going to be better. But are they going to come down? Right. And that's when you see if they think margins are going to come down, why they're going to come down. Is it pricing? Is it whatever? But there's a lot of stuff going on under the hood. And I mean, this earnings season, it's going to be I say this a lot, stock pickers market, where I feel like even the last 10 years, just do a dart and you make money. But there's a lot of stocks getting nailed right now. You're not hearing about big tech. You talk about growth catching up to value too. Value.
Wow. Wow. What a move. I was just
reopen
looking at
trade, right? Was big.
Yeah. Right. Now we're back on the panty trade.
Yeah.
You got the pandemic trade is happening again. You got the big tech concentrated in $8 trillion worth of net capitalization. You had Apple and Amazon hitting all-time highs, and Google and Microsoft, just those four companies. This is after you get an inflation read that's really hot and an instant move of the bond yields higher. Then the markets open, and all of a sudden it all turns around, and you get the NASDAQ outperforming, which is totally insane, by the way, except for one thing. Except if that's actually not what's going on. What's going on is not anything to deal with that, but it's more of a safety trade into bonds, right? And a safety trade into large cap tech, which is cash heavy, good balance sheets, buybacks are going on, easy borrowing and all that, and consistency, cash cows. That is what really, in my opinion, as we see a narrowing of the breadth in the markets, is something to watch. It's something that we saw in the latter part of, let's call it 2019, 2018 to a point also, and then during the pandemic as well, because we're seeing that reversal of the big trade of, infrastructure. But Frank, did they pass that infrastructure deal yet?
Not yet, but I think when they do, I think it's like 7% going to infrastructure. So I don't know if it's a big deal or not. But it's so. You know what I find funny? Is that both sides campaigned for the longest time on $1 trillion infrastructure package. So they both understand infrastructure, but we haven't gotten anything out there because again, they hate each other that much they can't agree to whatever. It's frustrating. I think
they're buffoons. They're buffoons. Yeah, the buffoons, all they're doing is talking about what can get them elected. Let's be honest about that, right? The thing is that they talk about this. I don't understand why the first part of this bill hasn't been passed if it was like a layup, except for the fact that we have earmarks, we have sausage stuffing, we have, a whole bunch of pork going into this right now. And I think there's a lot of problems with that. And I think there's some concern about how much is too much. How much of a good thing is too much. You want to do a little research?
You want to do a little research out there? So you look, everybody crazy with the Miami, right? Miami building close to the units for me in Florida. I'm in North, but you're in Fort Lauderdale. But still, that Miami collapse, that's a 1980 building. Guys, go and read the bridge and damn reports that have come out from engineers saying how important that there's a dire need to upgrade this stuff. Our water pipelines, everything. The infrastructure is extremely, extremely, extremely old. We need this. You have to come out with something. You're going to see more of this stuff happening. It's not going to be nice. You're going to see a dam crack. A lot of this, they're coming out saying with the engineers, we need this, just like they did with the Miami building. Not, God forbid if that happens again. It's just, you got to get that infrastructure updated. A lot of these buildings are old, a lot of dams, bridges. Come on, guys. I mean, this is, this is about people, it's about lives. But anyway, I don't want to get too crazy.
Around the whole country. But around the whole country.
Absolutely. Yeah. So let's get to the fun part of this, which I know you love and I know everybody loves, right, is your ideas. And you've been amazing when it comes to stock picks on this podcast, which we technically do Dollar Stock Club. You like a couple of picks. We'll get to one, which is pretty crazy. What I think is I like it, actually. It's just crazy when people are going to hear it. But let's go over some of your picks that you like right now, because there are a lot of interesting things on this list.
So, I mean, there's there's a lot of interesting ideas, some outside the range ones. One of the things that I'm looking at right now in a time when it's like, hey, things are going well because of this, or maybe this company's doing well because of that, is the idea of, hey, if something goes right, if we use the theme of if just one thing goes right for this company, they could be a great opportunity. A company called Workhorse, old SPAC. Basically, they make EV, we'll call them cargo vans to a degree, right? They're in that genre of all these other companies that are making some kind of EV for commercial usage in their particular instance. One of the big things that happened and why the company rose up for a while was that they were supposedly in the running for a post office deal, right? And what they were in the running for was to get postal trucks. And then we saw there was a big deal, a couple of, I think, $1 billion worth of deal that went to Oshkosh. Now, what was interesting about that deal was there was a lot of talk about EV. The whole federal government's going EV by whatever year it was. But yet a lot of the trucks that Oshkosh were building were either hybrid or some other form of fuel, maybe natural gas or something. Still maybe cleaner running than combustion engines with gasoline or diesel. But all of a sudden it was like, hey, what happened to Workhorse? And if you look at that chart, once that happened, Workhorse went like straight down. And now there's some lawsuits. Yeah, see that little, right there. Yeah, right. Mm-hmm. Boop. That's Oshkosh.
Crash.
Okay.
It's like a typical SPAC, right? They go up, and then the insiders are out, and then boom, goodbye. I love it.
But that was the news specifically on Oshkosh got the deal. Now what's happening is there's a renegotiation. Now you may say, well, the government never changed their mind. Well, I don't know about that. Look what just happened with the Pentagon deal that they gave to Microsoft. Now that deal was shut down, $10 billion contract. And you see that Amazon making all-time highs all of a sudden again as the potential for a shared contract. I would venture to say if one thing goes right with Workhorse, that the potential is for an opportunity. It's very aggressive. It's not for everybody's portfolio. It may never happen. But I'm just saying the opportunity. And you can see that when there was some discussion about this, the stock starts percolating up. So kind of an interesting situation there. I think there's 40% upside on that pretty quickly if we do see that even part of the contract goes there in their way. So that's one. The other one is DD, brand new. DD's interesting. It's you like this? You hate this?
Yeah, I'm gonna punch it up. You're crazy. I love it. I love the idea. I really do. So I mean, we everyone knows the story. It's been going crazy. Just IPO'd, right? Let's bring this up.
All right.
I'm using CNBC. Sites that people can follow along. So yeah, go ahead.
Yep. So the thing is that, do I love DD? It's fine. It's an Uber. Do I love Uber? Don't really like Uber. Lyft, and I'm going to lose money for a long time. Still, people like it. Investors like it. They do. DD does a lot more than that. They do deliveries and shopping services and car services. Well, you know what? The problem is that there's a lot of money being made in China right now, and a lot of the government agencies are like, you know what? There's a kind of a toll road here. You need to pay us. And they came out IPO'd, probably found something to do with the problem with how they held the data for the clientele. China shut down and took away a bunch of apps in the App Store. I am certain probably this is going to blow over. Pretty certain this is going to blow over time. Anything can happen. But just like what we saw with Ant Financial when Jack Ma got the hand slap and Baba and a few others came down and Tencent came down, I think that DD long term will probably just say, hey, we fixed the data breach, or not a breach, the data problem that you say we have. And by the way, here's a couple of $1 billion. Fine. Okay, thank you. They pay the toll. They're done. Stock goes right back up to where it was pre-news.
You know what I love about this pick, Andrew, is because when you're looking from an investor point of view, it's very hard to buy a stock like DD because you look at it because all the news out has been so negative, right? So people look at this thing and they say, okay, look where it was. It went up to 18. It's 11. And, most people want to buy it at 18. You're programmed to buy it when the most excitement's there and you don't want to touch it here. And it's up like 5%, take off its lows.
Right.
But what I love about this is what you have to ask yourself is what other negative news could come out on this, and there could be some. There could be like a whole scheme where they, but I mean, they took their app off. China's coming after them. It's infecting the whole industry. Everyone's pulling it. I mean, what else could go wrong to this thing? Where, like you said, with the last stock, right? If everything goes, it's just one thing. You need one thing to go right, and this thing's gonna go $13, $14 base out there. And if it goes right, you're looking at this thing really taking off. But again, it's Uber. Think about Uber here. Okay, Uber's great and they're international and stuff, but our population is a lot smaller than China. Other areas that so it's I kind of like this pick because it's against the grain and some people look at it. That's why I was laughing because no one's out there. No one goes on TV. So I'm gonna DD might be a good play here, but as a speculative play, this actually makes a little sense. So I hear you on it.
The other one is, I'll just give you one more, is the view that if in fact we are in a pandemic trade again, what isn't in the pandemic trade, right? So we see Walt Disney. Walt Disney has been a really great PR machine lately, better than anything else, in my opinion. They're putting up this stuff, and it's, I've never seen so much news between Boeing and Disney. It's like they share the same PR agency, I think, that's just constantly pushing out information, all the specs on the Black Widow and the stuff on Disney Plus and how great it was and how it wasn't. Well, you got that, you got Yum Brands, you got Viacom. We'll see what happens there. Starbucks, Everett Holt, AMC Network, Cisco. Hey, one of the ETFs out there is called the Travel and Leisure ETF. It has more leisure at the top holdings, but there's some travel below it. Thinking about shorting that. Looking at that as if, in fact, the pandemic is, whether we want to agree with it or not, Frank, is a different discussion, okay, of what's happening, where it's happening. If it does happen, if there are further, let's say, not even shutdowns, but quarantines or slowing of international travel, slowing of domestic travel, no more stimulus, but yet people can't get back to work and maybe some jobs being lost. I'm saying kind of if there is another wave, whether it's Delta Plus, there's a new Lambda variant coming out or whatever it is. And there was some weird story about somebody that had 2 different variants that got it. And now there's a whole discussion about breakthrough.
They're all covered by the virus.
I can't keep track of it.
Explain that. Yeah.
Right. Exactly. So I'm thinking about, let's take a quick short of PEJ is the symbol. Now, as a full disclosure, clients of Horowitz Company, myself, may own or short any of these. So I'm just making sure that's very clear when we talk about these.
Okay. I'm bringing this up now for you. So, PEJ, right?
Yep. PEJ.
Entertainment ETF. Wow. So shorting this?
Is there a holdings page there? Yeah. Shorting is kind of topped out, triple top on the top there.
Is there holdings? I mean, CNBC is really bad. The reason why I use it is because I like
look at the profile. Go down the profile. Here, there's the investment objective to the right. Fund 6 investment
summary profile. Yeah, too fast. Here you go. Summary news profile.
Go to the profile to the right. There you go. Fund details.
Objective. Top 10
holdings. There you go.
Bookings.
That's
right here.
This has been moving around a little bit because I got a couple of different holdings, but AMC's in there as well. So. Travel and leisure, just a thought. Consumer discretionary, consumer services, 94% of the overall fund it's showing right there. So something to think about.
Yeah.
If in fact this pandemic trade is happening and you look at the reverse and inverse of that, could be an opportunity to hedge out. The problem with hedging right now, you talked about this earlier, Frank, is what do you hedge, right? If everything's going up, if we're seeing a terrible situation going on in the gyms around the country, and meanwhile Planet Fitness keeps on going up no matter what, what do you hedge out? So instead of, and if indices are going up, but like today was a 2-to-1 earlier today, 2-to-1 winners to decliners to advancers. That was earlier today. But meanwhile, markets were kind of like in the nowhere zone, right? And the NASDAQ was going up. Which index do you short? better picking something a little bit more constrained, a little bit more directed, focused.
Yeah. I mean, with the Disney pick, I got to tell you, when it comes to Disney, Andrew, whatever I do the opposite, and you'll make money on it. Because, like you said, it's like when you Planet Fitness is like doesn't make sense. When I look at Disney, I bring this up. This is the only thing that makes me know, because everyone's going back to like their pre-earnings, like pre-COVID earnings. Everyone's doing great, and a lot of companies doing great. What I see right here, look at this line with Disney really quick, and I see, look, this is 2018, 2019. Look, 12. This is their net income. You can go to earnings. $8.
What line is that?
$6,
net income. Okay. Yep.
So look, even diluted earnings. So you got $8 and $6. Earnings came down a little bit, but then you got the pandemic. Okay, into 21 pandemic. If you look all the way out here. So here's pre-pandemic, 2019, $6.26. They're not going to get back to this level until 2023, which is insane to me because people are paying.
Where's the last? Where's the last one?
This one right here. If you could see this, 647. That number.
Oh yeah, I got it. Yep.
Everything's hiding. So that's 647, and that's 2023 numbers. And guys, I have your YouTube research page. I'm showing that. Anyway, they're not going to get back to those earnings for a couple more years yet. So earnings are really crappy, but you're looking at a company that's trading at 30 times forward earnings, commanding a massive premium. Again, whatever I say about Disney, do the opposite, you'll make money, because I lost money. I thought this thing was going to crash a lot more. But it will be interesting to see with everything opening up. Now they have all these users. A lot of them have come on for free. They're trying to raise prices for ESPN Plus, and let's see if they can raise prices. I think it's going to be very difficult.
That was another thing. They raised again.
So we'll see.
But Frank, some of these companies have a lot of change they can pull, right? They can, or what's the word I'm looking for? They can pull a lot of, they have a lot of things they can do. For example, that too. They could do a $1 increase on ESPN, right? Maybe they could do a $1 increase or 50 cents or whatever it is on Disney Plus. Possibly they'll do a quick up. Listen, the only thing they can't do, which would piss me off, is putting a higher price on those turkey legs that you get at Disney. Other than that, the smoked turkey legs, you've had those, Frank?
They're good. Yeah, they're really good. Yep. At Disney. Disney. And they're raising prices there too.
Levers they can pull. But a lot of the companies have this opportunity to do so. And just that incremental change of $1 or $5 on the park pass, getting rid of a discount for Florida residents, or whatever it may be, is really very beneficial to them, to the bottom line. So they did spread out. They've cleaned up their act a little bit. The problem is, are they going back, and what are people willing to pay? Because it's not so much right now that things are just great, as you just pointed out. You showed it right on the screen. The thing that is now is that people are willing to overlook and willing to pay up in advance of them getting there. That's why the market is at an all-time high.
Yeah. No, definitely makes sense.
So,
and Andrew, I guess we'll leave it there. I mean, I love when you share ideas. You always share really great ideas, and I really like the ideas this week, though. They're pretty cool. Some good ones, DD and Workhorse and stuff. But listen, we have to get together soon. I say this a lot. I love to go on your boat, hang out, see family again. But listen, keep doing.
Come on down. It's dolphin season. Mahi mahi. Hey, go over to The Disciplined Investor. Yep. Go to thedisciplinedinvestor.com. Listen to the Disciplined Investor podcast each and every week. DH Unplugged each and every week as well. Just look up Andrew Horowitz on your Googly thing, and you'll find out where you can get more information. Great discussion this week on the Disciplined Investor podcast. We talked about, again, jumper cables, trying to make it, Frank, what we're trying to do on that show is to make it really user-friendly. Understand very basic things. One of the things that we did over the last number of months is all about, hey, if you're scared to get in the market, that doesn't necessarily mean you should be in all the way or out all the way, right? There's some ways in which to get involved in investing for your future that you don't have to panic at any level, where you can have, as I call it, 1 foot in, 1 foot out through a process of dollar cost averaging. We have this really interesting strategy that we built in order to do that for people. So it's really been a great help to them over the last year and a change, especially when people were totally freaking out and pulling out of the market, then had no idea how to get back in. Then it was too late. Then it was too high. Then it's going to crash. I don't want to get back in. No. That's not how it works. We got a plan. We got a way to do this for you. So check it out over on thedisciplinedinvestor.com.
Awesome. So listen, Ian, thanks so much for coming on. And as always, I'll talk to you soon, buddy. Thanks, man.
Thanks, Frank. See ya.
As always, great stuff from Andrew. Love having him on. Really good friend, and always there to provide lots of ideas and lots of trading ideas, which is cool. I know you guys love, but I've known Andrew It's the street.com days. We'd be friends. Go to his house, slept over his house. His family's great. His kids are great. Just a really good person and someone that really cares about his clients, his listeners. But I love having him on. I really love having him on, and really great stuff. Again, I love people who provide lots of ideas, and he's always there to do that. Not only that, his track record has been fantastic. Has been very, very fantastic, which I love, right? That's why, you listen to this to find new ideas, and do Dollar Stock Club, we're able to track a lot of this and making sure we're getting the right people in front of you that have good ideas that are going to help you make money. And, he's one of the ones I've done very, very good. Not one, a lot of them have done good, but he's been doing really, really good. Anyway, I say it all the time. This podcast is about you, not about me. So let me know what you thought at frankcurzioresearch.com. That's frank at curzioresearch.com. Now let's turn to Daniel. Lots of stuff going on, buddy. I mean, we got earnings. I don't know, man. Where do you want to go with this? It's
sports, big week. So I'm ignorant to horse racing. This isn't like the start of the season, or is it a new season that you're going to?
No, I'm going
this
to.
This is just a yearly big deal.
So
at this track.
basically, it's like a 3-track system. It used to be, Aqueduct is open, then you have Belmont, and then you have Saratoga open at a certain time. But Saratoga is like the summer track where it used to be open only for August, and now they open a little bit early. But I'm going there, Saratoga, with my friends for opening day. And
is it opening because of COVID, or is it opening because of the season?
No,
okay,
it's opening because of season. Yeah, it's opening. That's the season that opens.
I'm one of those horse racers that know the Kentucky Derby, and that's it. Bigger and better on sports is this week is the Open, my friend.
Yeah.
That's exciting.
Zach Johnson's out, COVID.
Who cares? The Open's still going on, and I'm excited about that. So with the time change, I don't know what the time change is over there, but I'm gonna have to get up early. And
it's great.
Whatever. Anyway, it's worth it. So all you golfing fans out there, that's a big deal.
Yeah, I gotta tell you, one thing I love about the Open, it's one of the only championships that the winner, that person could win and finish like 6, 7, 8 groups behind. And the guys that are finishing are just dropping lower and lower because it's seriously usually like it's the top 2 guys, top 4 guys who are going to win when they're after round 3. But you see that a lot. Like you'll see guys just waiting in the clubhouse and everyone's coming in. Some guy shot a great score in the middle of the round, and it's I just love. I think everybody loves as a golfer where you love to see the pros struggle a little bit. This is a tournament that. If you're just not hitting fairways, good luck, but it should be really, really cool. It's awesome. So,
so I'm looking forward to that. But today, some excitement started. JP Morgan and Goldman Sachs kicked off earnings season.
Mm-hmm.
JP Morgan's boring, and we don't recommend them, so who cares? Goldman Sachs, though, however, knocked it out of the park yet again. Would you like to talk about the, Vampire Squid? Who started that? When did that happen?
I don't know.
I quote it because it is funny and it's true. But anyway. They knocked it out of the park. A couple of divisions had record quarterly revenue. They had record first half earnings for the year. We've talked about this a lot in the past, especially you, Frank. The environment of volatility, uncertainty, and really nobody else or nowhere else to go but here in the markets is huge game for them.
I mean, real quick to add to your point here is, listen, you have the perfect environment. You have government injecting trillions of dollars into the system. It's not yet fully thrown through the system. More trillions are coming for infrastructure. You got super low interest rates, so more people are borrowing. It's very easy to raise money. You have M&A activity near all-time highs, and you have incredible. NASDAQ just came out with the option contracts just under their record from March. I mean, when you have that kind of volatility and you have those perfect conditions, that's one of the reasons why I recommended Goldman Sachs a year ago and doing fantastic on it. And I keep saying it's going to get used to these results of them blowing it out. Like people say, well, investment banking, they can't really, forecast for it. It's going to be massive. They're going to be blowing out earnings. I'm just surprised that they're not raising it. This is when they say they beat by $5.17, and they reported earnings of $15. They're supposed to report earnings of like $9.80, whatever it is. So they beat by over $5. But who are the analysts that cover this? Like, that big of a beat. You got to expect like, hey, these guys are used to generating 25% returns on their investment bank. I mean, who are the guys in charge? Because that's the 985 is a consensus estimate, probably of 25, 30 sell side analysts covering Goldman. I mean, we pretty much knew they were going to blow it out the last 3-4 quarters, but yet they keep coming out with these numbers that are so conservative where it's kind of funny. But a lot of they're increasing the dividend by 60%. They beat in almost every division, but
that's huge. I mean, the dividend is huge, and especially in this environment and going forward, because we're always going to be talking about interest rates and what happens there. But big dividend payers, I gotta admit, I've been surprised and wrong on how yields haven't come down on huge dividend companies. Like, I still can't believe that tobacco stocks pay 5 to 7%. I still can't believe AT&T pays a huge dividend. But I'm okay to wait and continue to look at those. We'll get into tobacco maybe, but investment banking led by a huge backlog, so future orders coming down the pipe. And can we get into the Battle of the Grills real quick?
Yeah, go ahead.
Because one of those, do you have that article up? Because one of the, who is it, Frank? Weber and who's the other one?
I forgot that, but it's two of the leading grill
Traeger,
people, right?
Is it Traeger?
Yeah. They're both going public, yeah. Just awesome.
And Goldman Sachs is leading Weber, and I think it's Morgan Stanley leading the other one. And there was a hilarious Zero Hedge, who I'm a big fan of, as you guys all know, had a good article about the Battle of Wall Street and the Battle of the Grills. And I'm pulling a blank here. I'm trying to find the article that I had saved here to bring up for you.
So here it is. All right. So we got
And what stood out to me is Weber was profitable in 2019 and 2020, but had an enormous jump up because a lot of people were locked down, stayed home, bought grills. Have you seen the demand for backyard pools?
Oh, yeah.
I have an amazing friend in contact in Arizona who does pools in backyards.
Oh, it's insane.
Business is just booming. I can't wait to catch up with him this week. But Weber was profitable in 2019, increased it in 2020, but the other one had a huge loss in 2019. Do you see that paragraph? Do you have those numbers in front of you?
I have the numbers. So it's Traeger Grills, right? So TGPX, plans to list on New York Stock Exchange under the ticker, you guessed it, Cook, C-O-K. And then you have Weber Grills. I think Weber between $4 and $6 billion. Yeah, this is pretty cool. I mean, it is. It's just a big battle. But Morgan Stanley, right? So you have Goldman doing the Weber listing and Morgan Stanley doing the Traeger listing. So
these are good fees. And do you think you get like steaks and invited to cookouts as part of this? Or
I don't think it's even worth it for these guys. They make so much money. I mean, they probably own the steakhouse. You know, it's just why even bother with the free steaks or whatever? But it's just the amount of stuff that these guys are able to get. And also, Weber's offering, I mean, being led by Goldman, but also Bank of America, JP Morgan.
Oh, yeah, everybody's there.
And just, you look at these revenues, man. Traeger reported revenue of $545 million. Net income of $31 million in 2020. Weber reported almost $1 billion in sales in the 6 months through March. So I mean, you're looking at these are like real companies, and okay, if you just go right to your local Lowe's, and you're going to see tons of grills outside. But people are buying them like crazy. New houses going up, and people have money to spend, and also don't discount the outdoor effect too, right? Where people just
absolutely
inviting people over. Barbecues are fun, and in a lot of places, not in Florida, you were told that until July 4th you weren't allowed to have a barbecue with your family, or you're going to die from COVID immediately. Yep. So now it's all opened up. People are like, hey, let's have people over. Let's have fun. We saw the home run derby too. Millions of people there. They're doing interviews without the masks on. It's just nice to see. Very nice to see.
And this is this is the pipeline that Goldman has. So we had some fun with the grills going public and all that, but those are investment banking fees. If this is the great environment where you have a lot of money sloshing around in the system, you still have eager retail investors. I know you were talking about the retail investor and the power that they can enforce and get behind. So this is a win-win situation. Why not go public if you're Weber? You love to see it as a Goldman Sachs group. You're going to close that deal sometime in the next coming quarters or whatever. And so investment banking stays strong. Asset management is huge. And of course, they're just amazing traders. Even though their commodities and fixed income was down 40-some% year over year. Now, that's a little tricky because year over year comps or comparable sales, you're comparing this time of year during last time. Obviously, with the coronavirus, the lockdowns, the volatility was extreme. So their trading desk and revenues went through the roof on the fixed income side. Even though that's down, say 40-some%, it still came in, I believe, just under $5 billion, give or take.
Yeah.
And these guys are it's a boring story now, but hopefully all the CRA subscribers got into that. And, you can't beat them, so you join them, Frank. That's the morality of investing today.
We're going to talk more about that in morality investing, where this is going, because you did talk about Goldman Sachs, right? Which is pretty funny. What was that? How much was it last quarter, last year, the comparable?
Yeah, so I was just going through it real quick, and I loved it because they said, so they reported $15. Let's see, where's it at?
Yeah, $15.02 per share.
Okay. So they were talking about in the prior year, this is just from like page 1 of the earnings release. So in the prior year, net provisions for litigation and regulatory proceedings reduced diluted earnings per share by $8.23 for the second quarter of 2020. Obviously, that's when they took the big charge off and all that kind of stuff. But, it goes to your point when you opened up. There's just certain people that get away with certain things. There's rules, and when you're in a situation, and I have family and friends that can't stand the line of work that I do because they think Wall Street's a bunch of crooks. Everybody knows that kind of argument and knows there's a little bit of truth in that. But it's crazy because you don't get to set the rules, but these guys get to, and they also get to jump on both sides of them. So as an investor, you can use that to your advantage. You can avoid it. You don't have to buy it, but it just shows you how there's a set of rules for certain people and everybody else. And this is a way for the quote unquote little guy to at least get a return. So. Yeah.
And those results just driven by, corporate lending, higher net revenue underwriting. And you saw the same thing with JP Morgan, really good results, earnings of $3.78 per share, beat estimates by 69 cents, which I was surprised to see. His revenue fell 8% year over year to $30.5 billion. So sales fell, but again, you have interest rates lower, not as good for these guys, but still they beat estimates. So they brought a decline in revenue. I mean, just to put that in perspective, I think Goldman Sachs grew revenue by like 12-13% or something like that. So investment bank $36 billion. Yeah. So when you're looking at some of the things that stood out to me with JP Morgan, they said the surge of advisory activity continued Q2. That's M&A equity underwriting fees up 9% due to strong IPOs. That continues. But a couple of things. Debit credit card spend was up 45%. And I like what these guys are doing where it's up 45% year over year, but they say up 22% versus the more normal pre-pandemic second quarter, right, of 2019. So it gives you a better comparison of not only it's not just, hey, the stay-at-home stocks benefited tremendously and now they're starting to come down. When you're looking from 2 years ago, now you're seeing that comparison where you're seeing there's a lot of these companies are growing a lot faster and people are spending more money. Earnings are all-time highs, but yet, again, pedal to the metal for the Fed and they keep going. I don't know why. It's another conversation. But expect accelerated growth across travel and entertainment, originations and home lending up 64% to $40 billion. Auto up 61% to $12 billion, very strong. However, if you're looking at this division, which is the consumer and community bank, the whole division, loans were down 3%, reflecting elevated prepayments in mortgage and lower credit card balances. I found that interesting. What it's telling you is that, not only people's household wealth is increasing, and that's probably due to your home price or whatever, but people are paying off their mortgages and people are paying off their loans. They're spending money, right, which is just show, but they're also paying down their debt. But just, when you're looking, I don't know what to make of that. That line kind of just surprised me. Like, JP Morgan's going to make more money the more loans they give out and stuff like that. But the fact that reflecting elevated prepayments and mortgage and lower card balances, I think, that's a good thing for people. It's not a great thing for the market when you want more debt, more spending, right? When people start hoarding their money in savings and start lowering their debt, that's less money in the economy, right? So, but it's good personally. You're lowering your debt. But anyway, I just found that interesting. And we're in a super low interest rate environment. Maybe their mortgage was at a higher interest rate and stuff like that. It made sense to pay it off, refund, whatever they did. But overall, you're looking at results that are absolutely amazing across the board. Any of you that are concerned about the banks, forget it. They're more strong than they've ever been. You've seen the numbers. Even the chargebacks, they made money off of fewer chargebacks. They've never been stronger. The consumer's never been stronger right now. For most people out there, I know there's still people struggling, and that's evident. You're going to see that in the rest of the earnings reports coming out the rest of the week for banks and financials. But you talked about something else, which is a bigger point, right, Daniel, which is the moral argument. And we're trying to get that and pound it home to people, because one story out there, I'll let you go to this, where Trump is suing big tech, right, for imposing illegal, unconstitutional government censorship. Yeah. And it's a big story. Then you have, on the Biden side, right, they say they're going after big tech and stuff, and, which is kind of funny when you think about it, since, they suppressed, I think, all the leading conservative sites for them, which is cool. But we're going to go after tech, and, we all know how much money they spent on that election to support them, which is fine. But when you're looking at one thing first is from, he's suing him for illegal, unconstitutional government censorship, which is kind of a joke, because I think people have to realize that this is a free country, supposed to be a free country. So when you go outside your home, you can say whatever you want, right? You could be a KK member, burn a national flag in front of it, be a racist. That's your freedom of speech. It's hard, but that's freedom of speech. But when you're at a company, you don't have freedom of speech anymore, right? You have to abide by the rules. If you don't think so, if you're in your office, stand up and try saying something that, hey, men should be paid more than women because they're superior. Try saying that in your work environment, you'll get fired in 1 second. You don't have freedom of speech when you're under that corporate umbrella. It's always the problem I had with dealing in the NFL. The NFL pays these players. They own them. They could say, hey, stop kneeling or we're not going to pay you. But, using that platform, someone else's platform for your agenda, whether you agree with it or not, was just kind of funny to me. But, whatever. The bigger point here is the moral issue, because when you're suing big tech or you want to go after big tech, the more these announcements come down, you say it all the time, right? With Facebook and everything else and the Justice Department. I mean, the more you see this, the more what?
Yeah, this is a layup. I mean, these are, in order for so these companies are they're very well-run companies. They're very profitable companies. And I'm talking about Facebook, Twitter, and Google. I mean, margins are huge. Cash flows are amazing. Growth is amazing. I don't have all the numbers right in front of me, but I mean, and look at the stock charts. They're doing well. I think maybe Twitter isn't at a 52-week high, but I believe the other two are, or damn close. Yeah, I just think, so we were playing and having fun with this about the morality of this, but you know, you can't beat them, join them is something that's funny. A lot of people, getting back to the tobacco real quick, a lot of people don't want to invest in tobacco stocks. They don't want to have exposure to marijuana stocks. Some even take it further. And hey, you're allowed to do whatever you want, in my opinion. I'm not going to sit here and say you're silly or stupid or whatever. But I remember when I was starting out in the brokerage business, a lot of people didn't want to own fast food companies. They didn't want to own tobacco companies. Okay, I get you. It's very hard to buy mutual funds and not have any exposure and to guarantee that you don't have exposure to that. But anyway, so if you're buying Facebook, you're okay with banning certain people over political comments and or beliefs or whatever. And I'm not here to say that's good or bad. I'm simply saying that if you're selling these stocks because you're worried about government intervention and or breaking them up, I think that's a huge mistake, because there's one side of the political aisle versus the other side. And if you think that big tech is in bed with the current administration and you think they're going to crack down on them, I just think that's a real stretch. And I would take the other side of that bet. And look at Facebook, Twitter, and Google. Their charts are amazing.
Yeah. I mean, you've said that, you're buying those stocks, but that's the thing. It's, if you really think that this is going to, the big tech company is going to be broken up, you should be buying them like crazy. I mean, they're going to be worth so much more individual when you break up a company. That's called sum of parts value. Usually when people talk sum of parts, you should sell the stock right away, because no one talks sum of parts.
Well, like as you say, when that's your lead in.
When that's your lead in,
for
that
reasoning,
means
yeah.
Nothing else is working with the company. The business model sucks. Management sucks. There's nothing else to talk about. But you say, hey, if we really break up the company and do this, then this could happen. Just sell the stock. It's the best thing. But I mean, sell side
what did Richard Gere say in Pretty Woman? He bought his dad's company, was the first company. He bought it and he broke it up into little pieces and sold every one of them.
Yeah, sold it. Yeah, yep, I remember that. Yeah, Sir Roberts. But
I fired him and I took it over. I broke it up and built it or sold it off into pieces. So yeah, if that's your lead in, that's a negative. But
getting back to the moral argument, you have to realize this. You are investors. You want the best for your family. You want to make the most money. And I'm not telling you to do the wrong thing here, but our job is to bring you ideas that can make you money, and ideas across all spectrums. Like psychedelic stocks are now, there's not too many publicly traded stocks, but wow, I mean, the research coming out of that is pretty amazing. Big banks, right? I told you, we did a whole segment on this, I think probably like 3-4 weeks ago, saying this might be the most powerful sector I know from a risk-adjusted basis. It's a no-brainer. You have low interest rates. These guys have all this money. The only thing they can do is buy back their stock or raise their dividends. And you're seeing a perfect storm where GDP is growing, household wealth is growing, more money entering the system, more loans, interest rates low. It's a perfect system, perfect storm for these guys. They're bigger than ever. They have tons of cash in the balance sheet, which they're forced to keep on the balance sheet from crazy freaking restrictions. Sure. And what's the worst case scenario? Say we have a massive recession. What's the government going to do? We know exactly what they're going to do. They're going to throw money at it, just like threw money at COVID, just like threw money. They're not seeing the negative impacts from throwing trillions into the market. All they're seeing is, hey, we're padding our pockets and everybody's happy. Stocks are going higher. People are getting richer and we're happy. There's a massive divide between the rich and the poor. It's getting wider and wider. But even during the credit crisis, same thing. Hey, let's just backstop all the banks and everything's fine. So you're going to see that come on a risk-adjusted basis. It's banks. Look at big tech, what we say. Well, they're stealing all of our information. We all know it. They're using AI to predict our future. They know everything about us. A lot of these things you don't even know about. Most people don't. They think they do. They don't. Try reading. There's a reason why websites all the time, Daniel, update their terms of service, of agreement.
Yeah, the tracking.
It pops up all the time. You know what? Just they should highlight the changes in that, because that's basically saying, okay, here's another way that we could track. It's another way it's going to track. Another way we're going to sell you information. So you see that on so many websites where it's almost like you have to click here just to view it, and you just click it because you want to see the story, right? So you just click it, and that's the okay. But psychedelic, marijuana stocks you brought up, also gambling stocks. Mm-hmm. I mean, these things are getting approved. Look, if you don't want to buy them, you don't buy them. That's fine. But right now, in this investment environment, there's room for you to make a lot of money on new trends, on things that are going on. And some of that requires you, buying some stocks that are, vice stocks or things you don't agree with. But you have to check that at the door. You do. Again, for me, I recommended marijuana, but tobacco companies. And my dad died of lung cancer because that's my job, is to make you guys money, right? I don't agree with it. I know they lied to everybody. They got fined tremendously, but they pay good dividends. And one time or another, I thought the stock was a great buy. So yeah, you have to put those feelings aside sometimes, because if you don't, somebody else is going to make a ton of money off of it. And that's what they're doing even on Wall Street, which my opening was about. But the whole moral argument, Daniel, you bring up a really good point.
Yeah, we'll get into more of that as things unfold here. But we're not telling you to go against anything that you believe in. We're just kind of saying, hey, from our perspective, and there's certain stocks. It's not tobacco or gambling or anything like that. But everybody has a line that you would draw in the sand. Everybody is getting political. There's a lot of divisiveness out there right now in culture and everything. The pendulum will continue to swing one way, and then it goes back and forth. What stuck out to me, last thing I want to talk real quick, Frank, is just I want to see if it's a trend or just kind of a one-off. But Pepsi reported strong earnings today, raised fiscal year guidance on earnings per share. I don't know about revenue, but earnings per share matters more to me. On a CNBC interview, he quoted and said, "We're gaining market share from that company in Atlanta, Coca-Cola." Mm-hmm. Now, that's a shot across the bow in a funny way, because Georgia passed voting laws. I don't know if it got through, but they're trying to pass them if they did or they didn't. But Coca-Cola and a lot of people came out and were saying how they were against those. Doesn't matter where you think on that. The point is that now you have stances. Not only do you have people using their platforms, but you have corporations using their platforms as well. And I want to see if people start voting with their wallets. So does Pepsi continue to gain market share? How much market share? That was just a one-off, one line, but that stood out to me, because if people actually made a conscious decision to switch over from Coke to Pepsi, which I find hard to believe, that'll be interesting as a bigger picture and a macro thing of where kind of sediment's going.
Yeah, that quarter was really good organic growth. They really kicked ass in that.
And I think they're going to grow at 6%, which for a conglomerate like that organically, with the options to buy and merge a lot of things, it's amazing. So
Mountain Dew products.
Keep your eye on Pepsi.
I've got a minute left. Well, like 30 seconds left. So really quick here. Who's don't say Koepka. I know it's your boy, but who do you think's going to win the Open?
If it's not Koepka,
we love Koepka.
It'll be it's not Lowry. I don't think he's going to repeat.
Rahm is a favorite. Jordan Spieth the second. Rory McIlroy is up there too, which I'm surprised.
I'll take McIlroy. I'll go with McIlroy.
I was thinking, but he just didn't make the cut last, I think, Scottish Open. But for me,
only because he just signed the deal with Drive Shack, which we'll do a video on or something.
This sounds like a favorite pick, but I'm going to take Bryson.
Oh,
because
gosh. Here we go.
Only because. His
look at that. We're out of time.
3, 4, 5, 6, 7, 8. He's ranked like plus 3,000 of the odds, where John Rahm's plus 700, but he's ranked like 10th. I'm surprised because he did have that meltdown on the back nine in the last major, but he did play pretty good in that event.
Hey, it's a flat course though. He can hit it forever.
Yeah, I know. It's he's got a good short game. We'll see, but I like Bryson for this. I think he'll bounce back, but we'll see. But Daniel, thank you so much for coming in. Thank you so much for going over the topics. Listen, earnings season, guys. If you're subscribed to all our products, you're going to get lots of alerts coming out about all the earnings and everything. And Goldman Sachs just reported. We're going to be writing that up for everybody, but we like to send them. If there's something that reports where a company of ours that reports and it goes down 10, 15%, we send that alert out right away, let you know what to do. But, otherwise we send out, everything, just update on the earnings if our thesis is still intact. So you're going to see a lot of that if you're subscribed to our product, because, everybody's going to be reporting in the next 3 weeks. So, Dan, thanks so much for coming on, buddy. And, looking forward to hanging out with you next week, man.
All right. Yeah. Cheers.
All right, guys. So, listen, that's it for me. Like I said, www.curzioequityowners.com. It's absolutely for free if you want to take a look at my vision of security tokens and also the financial publishing industry, which so many new names are coming in. It's really, really cool. Again, that's absolutely for free, that presentation. We spent a lot of time getting that done. Really, really cool stuff. But I think you'll have a better understanding of where I want to take this company and the absolute huge potential we have to be an industry leader in two emerging growth industries, massive industries, and pretty exciting times. So if you're interested in that, if not, no worries. But if you do have a couple of subscriptions to our newsletter, especially Curzio One, or if you're a CEO holder, if you own our tokens, where you get equity stake, they trade on merge. Definitely give a listen, because that's important to you guys, especially your shareholders. And, love questions, comments, frankcurzioresearch.com. Feel free to email me anytime. So, guys, that's it for me. Thanks so much for listening. And as always, I'll see you in 7 days. Take care.